Today's Animal Spirits is brought to you by YCharts. Michael, a lot of times when markets are boring like this, it feels like there's not a lot to say to clients because, there's not much happening. The time to say something is typically when things are going crazy and there's a lot more to say. YCharts is here to help you with that because they have their top 10 visuals for prospecting client meetings, and they have all these different charts that you can use as jumping off points, right? So one of my favorites, the Asset Allocation Quilt. They've got some good stuff on the power of long-term investing and staying invested and timing the market, dollar cost averaging versus lump sum, all this stuff. Good stuff for client communication because I feel like the charts tell the story.
Amen.
Every quarter, YCharts updates this handy slide deck with fresh data and visuals to help advisors easily explain complex topics. Click the links in the show notes if you want to get your free copy of this and get 20% off your initial YCharts subscription if you tell them Animal Spirits sent you. Welcome to Animal Spirits with Michael and Ben. Michael, a month ago, you and I, on this very show, pounded the table and said the Fed needs to cut. That was the title of our podcast, June something, middle of June. It seems like last week that became consensus. Not that we were really ahead of the boat, but we just said, hey, let's just rip the Band-Aid off and let's do it. Inflation appears to be cooked for the time being.
Not according to my jet ski renewal, or my insurance renewal. I just got the bill today from Progressive.
Okay.
Up 21%.
Yeah, but what do you pay on insurance for a jet ski? Like $100 a year?
No, it's not nothing. It went from, it's $960. I can't remember what it was, $790, whatever the number was. Whatever to get to 21% higher. It's $960 today. It was $7 something a year ago.
You pay more than $700 for jet ski insurance.
Mm-hmm.
What is going on in the state of? I pay like $200 a month or a year for my boat. For insurance.
Well, you've got a pontoon boat. How many accidents happen on that lazy hunk of metal?
Okay, that's fair. So the idea that
you have a pontoon boat on a lake.
Okay, I don't want to get into this right away, but the jet ski people, not you, with boats are the worst. Jet ski people are I used to be a jet ski person. I know how this is.
Jet ski people.
Jet ski people are the worst. You know why? This is not you because you do it in a different way. But on a lake, jet ski people are the worst because they just try to go in and out of your wake all the time.
That's okay. I get it.
I get it. They go way too close as a boater person who's trying to boat safely.
The boater person.
With kids, I can't call myself a boat person because I still call it parking, and I get made fun of because it's actually docking.
Docking.
Yeah, I'm sorry, I can't call it docking. It's parking. But the jet ski people go so close to your boat, and I have kids in tubes and stuff. Like, just stay back, jet ski people. All right. Longview Economics. U.S. core inflation ex shelter has now been negative 2 months in a row. Last time this happened was in the pandemic. Otherwise, before that, 2015. So it's been a while. And we've talked about this for a long time, that the shelter component is lagging. It's an average, and it's backward looking. And Jeremy Schwartz has been pounding the table on this too. If you look at inflation with rents where they are now, it's way lower, and that finally seems like it happened.
Yeah,
this past month, which is funny because everyone's been talking about it.
Yeah, the consensus is that they should go amongst people that talk about this stuff, but in terms of like the market consensus, they're not going. It would be just if you look at like the implied probabilities at the CME FedWatch tool, they're not going. It would be a big surprise if they go in July. I'm not quite sure why. Neil Dutta, the expert on this stuff, we spoke with him on TCAF. Also, not really sure why they're not going, despite all the evidence that suggests that they should. Sounds like it's going to be September.
Matthew Klein had a similar point. He said, for whatever reason, the Fed seems loath to make changes in a quick manner.
I love that for whatever reason.
Yeah,
I asked Neil, I was like, why aren't they going? And his answer was, reasons. I'm like,
yeah, he didn't know.
Reasons.
He said they prefer to move gradually in the same direction over multi-year cycles, even if the economy itself does not work this way. And I totally agree. Why couldn't they just say, hey, all right, we're gonna cut rates now, and if inflation does come roaring back somehow, then we'll raise them again? Why can't they just do that? Why do they have to wait and go so slow and have it be this slow, gradual process where they want, like, they're talking to do more than their actual cutting or raising?
I couldn't tell you.
All right. So here's from Indeed. The U.S. has posted wage growth has stabilized. So they show wage growth peaked at 9.3%, now down to 3.1%. This essentially tracks the path of inflation, even if the values aren't exactly the same.
This was the big one. This was the one that in 2022 had people worried, right? Like one of the stickiest parts. And turns out that we beat it. We did it.
Do you think that the people are going to kind of look back at this and say, are they going to be okay with the trade-off of, wait, slower inflation actually means slower growth, and it also means slower wage growth? Are people going to be okay with this trade-off?
I don't think people do a lot of looking back. I actually was listening to our podcast last week, and you said, in 10 years from now, are people going to look back and say, what was wrong with us? We had it so good. No. I mean, do you look back to 10 years ago and think anything? You just live your life today.
No. There's a huge nostalgia element to everything that happens these days. People talk about the 2010s with this like glowing revelry now. When at the time, everyone hated it.
Who's they? Who does?
The royal they. Everyone talking about 0% interest rates and things were easier back then and we didn't have inflation and the economic community, you don't think that there's talk like that?
No. That the 2010s were like somehow golden years? There was no growth.
No, like better than this situation.
Nah, I think you're making this up. I think this is like in Ben's brain. I do.
Okay. I think there's economic nostalgia. People talk about the 1950s still all the time. You don't see this stuff?
Okay, but that's the 1950s. I'm saying we're not going to look back. Do you look back at 2017?
How many political campaigns are based on the fact of, are you better off now than you were 4 years ago?
You're moving the goalposts.
This is something people do.
No,
this is something people do.
No.
It's true. All right. I will say 3% inflation right now, from my perspective, is way better than getting to 2%. Because if it gets to 2%, like the risk then is the overshoot to the downside. I think that's like the recession. So I think inflation staying where it is now is actually a better scenario for us, right? Than hitting some crazy Fed target for whatever reason. Again, reasons. Okay, this is from Axios. Some parts of inflation were actually good. Just over 13% of workers in the U.S. are now earning less than $15 an hour. 2 years ago, that number was 32%. This is from Oxfam. Even after accounting for inflation, $15 an hour in 2024 has the same buying power as 2022, which is remarkable progress. They say their definition of low-wage worker this year has gone from $15 to $17 an hour. And they show this share of U.S. workers earning $17 an hour or less. So that part of it has gotten a lot better. And inflation is part of the reason for that. Obviously, part of that is just inflation, but those wages rose faster than the price increases did.
So 23% of U.S. workers earn under $17 an hour. That's a lot. I think that's probably more than I would have guessed.
I don't know. When you think about young people in the workforce, and it does sound like a high number, but the point is that it's progress. It was way worse before.
Okay.
How's that?
All right. We had a few people send us this chart from Visual Capitalist on fast food inflation. So over the last decade, McDonald's raised their prices 100%. They show Popeyes and then Taco Bell, Chipotle. We'll get to Chipotle in a second. But the food, so that compares to food away from home inflation was 49% over the last decade, and some fast food took more advantage of it than others. Like Burger King, for example. Burger King, Chick-fil-A, Arby's, Wendy's were only 55% versus McDonald's, Popeyes, much higher.
Do you think that part of that is because the prices at McDonald's always used to seem to be so low that their inflation before was far under the rate of inflation?
Yeah, I mean,
it had to be.
I remember in high school getting a junior bacon cheeseburger at Wendy's was the best dollar you could spend ever. It didn't make sense. It made no sense at the time. I remember like, this is too good to be true. My taste buds are exploding with joy, and I'm paying $1. They were too low. Maybe like how home prices were too low, fast food was too cheap.
It's possible. It feels like it's a little bit of this is catching up.
Okay. Mike Zicardi tweeted from Bank of America. Chicken wing prices up 190% over the last 2 years. Do you guys have Wingstop by you?
I have one right by my office.
You ever get it?
Never tried it. No.
Okay. I'm wondering about Wingstop because somebody sent us a research report. We were talking about Chipotle. I think we were like, how the hell is their market cap so high? Were we having that conversation recently? Or am I?
Yes.
Yeah? Okay. So Chipotle's market cap, what did we say it was? I just got logged out of YCharts. Let me log back into YCharts.
Isn't it 90 billion or so?
I thought it was, okay. I thought it was 70, but either way, it's many, many tens of billions of dollars.
Yeah, it's close to 80 billion, 78 billion.
So somebody sent us this report. Chipotle currently has 3,400 stores, with the vast majority within the United States, and is targeting an annual unit growth rate of 8 to 10%. So these are the economics on Chipotle. I can't believe I
Wait,
never
so
bought. I can't
I
believe
never,
What?
I never realized Wingstop was a publicly traded company. Is that where you getting to this?
Yeah. Wingstop is big.
It's
Wingstop
a
is like
it's a
11 billion.
$11 billion company. How is that possible?
Yeah. So Chipotle, these are the economics from this research report. They spent an average of $1.2 million in development and construction costs per new restaurant. Once a new store is fully operational, average unit revenues are expected to be $3 million, and operational cost per store average 76% of revenue, so operating margin is 24%. This revenue and operating margin profile implies $720,000 in expected annual operating income, a 60% cash-on-cash return, and a payback period of 20 months. It's a hell of a business, no?
That's not bad at all. That payback period seems pretty quick to me in terms of restaurants. Where I always think about the restaurant business or any sort of food business and the margins on them and how difficult it must be. But obviously, Chipotle's got it figured out.
Anyway, so Wingstop was like a similar investment profile. I can't believe I don't think I ever owned Chipotle, which is pretty embarrassing considering like how long I've loved their food. I was a I can't say quite an early adopter, but I remember getting Chipotle 10 years ago. But even still, I guess there's revisionist history because 10 years ago, the stock price seemed insane. Didn't Bill Ackman put out a short thesis on Chipotle about it being just an expensive Taco Bell?
Yes, he was saying that you could go to Taco Bell instead and get just the same. But remember the whole thing with
Because
them.
the price, like the fundamentals never seem to justify the size.
But don't you remember the whole food poisoning thing?
Oh yeah,
Because some people got sick and
Yeah.
that like the stock actually sold off on that.
yeah.
That should be like a Warren Buffett type buying opportunity, like American Express with the salad oil stuff back in the day,
Yeah.
right?
But this is like basic B thinking. Like, let's just say what was the market cap in 2000 and like it always seemed too expensive,
Yes,
which is the case for all these
all the growth
wonderful
stocks, right?
stocks.
Yeah,
Yeah.
that's the thing. Yeah, I think that we mentioned before. We mentioned last week that, geez, why is this company so expensive? It's probably always been expensive.
Yeah. Yeah. All right. Chart Kid made an incredible chart looking at all the first Fed rate cuts going back to 1970. And there is, I think, this idea that the Fed normally cuts out of panic. Something breaks, and then they rush to lower rates. And
Because that's been the experience for the past 20 years.
yeah, and that's just not what always happens. So we have a chart showing all of the rate cuts that did lead to a recession or did happen in a recession, and all of the ones that didn't. You're looking at the S&P 500 performance in the year after. And it's about a mixed bag. Would you say like 55% of the time there is a recession, something like that?
60,
50,
40.
yeah.
But yeah, if you look, the last time it happened was 1995, but before it was in the 80s and the 70s, and it hasn't happened very much lately where there was a rate cut and then there was no recession. So I think people just think in their mind like that can't happen, but it happens. So that's a whole thing, which this seems obvious to say. If the Fed cut rates and we don't have a recession, the stock market probably should be fine. If they do cut rates and there's going to be a recession, the stock market won't be fine. That seems pretty obvious, but I think some people needed to hear that.
Yeah.
All right, I did a little chart here. The inflation rate against the S&P, and it's kind of crazy that the S&P bottomed in October 2022 when the inflation rate was still 8%. And the stock market got ahead of this, that like this was coming down. And remember, people kept saying, why, higher for longer? Why is the stock market doing this? This doesn't make any sense. It should be going down more. And the stock market, once again, got this right and front ran it, just like it did with COVID. The stock market has a pretty darn good track record these past few years.
I have a very vivid memory of the day the market bottomed. It was Thursday, October 22nd. Josh and I were driving to the city, and inflation came in at over 8%. And the Dow opened down 1,000 points, closed up 1,000 points or something like that. It had like this wild candle, and that was the bottom.
And then it turned green, right? Yeah.
Yeah.
That same day, I remember that. Is it too easy and too cute to say that when the rate cut finally gets here, that'll be the sell the news moment? If I'm just trying to put my contrarian card on the table, just slide it in there. It's too easy, right?
I would say it's too easy. Doesn't mean it's not possible.
Right.
But sounds a little bit too easy.
Okay.
Right? It's like one of those things like everyone knows that that's going to be sell the news, and then therefore It can't possibly, but now everybody thinks it can't possibly be the top, so now it's actually going to be the top.
So the other, you are getting after me about straw man arguments from before about people being nostalgic for the economy.
I'm not. I didn't say it's a straw man. Say it's in your brain.
But I think that's a definition of a straw man. I think one of the straw man arguments these days is that some people always fight against like the 0% rate. I don't think anyone's calling for 0% rates.
No.
Right? Like I feel like there's a lot of people who keep saying that.
Actually, there might be one person.
Who's that?
Kathy Wood.
Oh, okay. She won 0%. All right. She probably would like those days again. So I don't think anyone's calling for that. And that's the thing is that the Fed starting to cut does not mean that, like, I don't know. What's a good number for them to get back to? 3% would be a pretty normal thing for this environment eventually. Like, that's the path, you would imagine? 3 to 4%, something like that.
We say what? The Fed funds rate?
Yeah.
Yeah, sure. Sounds reasonable.
Until there's a recession and then they go back to zero again? No, I'm kidding. Anyways, but yeah, I don't think that 0% is happening. All right, we haven't talked about flows in a while. One of your favorite topics of yesteryear. This is Bank of America inflows into large cap U.S. equity funds on pace for the second largest on record. The thing that stands out to me here is not the past few years when there's these massive inflows into large cap funds. It's the whole 05 to 19 range when there was essentially no flows into these funds at all. Do you think this is just the hangover period from the great financial crisis? Because it looks like here there was 1 or 2 years where there was positive flows into large cap funds, and other than that, nothing.
I wonder what's in here.
It was outflows.
What's in here exactly? Like, is the S&P 500 U.S. large cap?
It has to be, right? Because all the flows these days are going into what, VOO and SPY, we said?
So assuming, all right, whatever. Either way, this chart's pretty remarkable because to your point, from 15 to 20, given the sick run that large growth had, no flows?
This is the whole funny thing about the 2010s to me is that housing prices and stocks were a very good deal in the 2010s. And few people wanted to buy them. Now they're way more expensive and everyone wants to buy them.
I'm thinking about buying Chipotle now. They just filled the gap. Stocks at a pullback, a healthy uptrend, looks good. I can't buy it at $5 billion. It's too expensive. At $78 billion, now we're talking.
One of the themes we've talked about in recent months and years is just how much smarter corporations are these days than they were in the past. Torsten Slok had his outlook for public and private markets, and he shows the public investment grade market has grown from $3 trillion in 2010 to $9 trillion today. And look at how this thing takes off after 08 and 09. That graph just goes from minor uptrend to huge. Corporations took advantage of the ZERP era.
Yeah.
Look at that. Just a ton of issuance. And I'm sure more companies in the high yield and leverage loan market would have done so if they could have. But the corporations had the ability to borrow, and they did. So it's the Buffett quote about don't borrow when you need to, borrow when it's cheap or when it's whatever the quote is. Corporations actually did this, and that's why they were so well positioned for the rising rate market, because they borrowed a ton when they probably didn't really have to.
Yeah.
Good chart. And the next one is just the profit margins. They're estimating profit margins continue to rise through 2025. This is Bloomberg estimates to further record levels. It is kind of crazy that S&P 500 companies could live through 0% rates in COVID, going into 5% rates and high inflation, and then going back to lower rates that, regardless of all those environments, profit margins just continue to rise.
Well, they came in pretty significantly in 2022.
Not really.
Yeah, they did.
For that inflationary period,
I mean,
I don't know, 14% to 12%?
Yeah, it's big.
Not considering how much they rose before that, though.
It's impressive. I'm just saying, it's not like they haven't.
They were still on trend pretty much if you look at from the 2010 level. Do a trend line on that. It's still pretty close.
How about the market, the rally is broadening. I know you're not really a stock market guy, but you're watching the stock market?
What do you mean I'm not a stock market guy?
You've been watching.
I worship the stock market. What political party are you, Ben? I'm the stock market party. That's me.
You see the rally.
So what was it? Small caps were up 3% and the S&P was down 1%-ish on the day the inflation print hit.
Yeah. All right. Let me some good data points in here. Let me go to this channel. Here we go. Okay. From Bespoke, the Russell this is Today, the morning of July 16th, it's Tuesday morning, the Russell 2000 is trading up another 1% pre-market. If the index closes higher by 1% today, it'll be just the fifth time since 1979 that it has had a 5-day streak of 1% gains. Ryan Dietrich tweeted something similar. The Russell 2000 is up 1% for 4 consecutive days. Since 1979, when the index started trading, this has happened only 13 other times, and it was higher a year later, 11%. I'm sorry, 11 out of 13 times, up 25% on average. Why is this happening? It's quite simple. Higher rates are just really bad for small cap stocks. Why are higher? Because their debt is more floating. They're not Microsoft. They don't have the luxury of paying 100 basis points over the 10-year or whatever it is. So
Right.
higher rates really, really hurt them.
Right, that chart of IG market, the investment grade market, that chart that we just showed, that was the bigger companies taking advantage. The smaller companies couldn't take advantage nearly as much to get ahead of it and borrow a ton of money.
We've used this chart from Bank of America a million times. The S&P 500, like 85 to 90% of their debt is long-term fixed. The Russell 2000, I think it's like half-ish. So
this would be a very healthy development in my book. The Mag 7 stocks slowly but surely underperforming, which is kind of funny because I was told that tech stocks were a low rate phenomenon. And then they did well when rates went high. Now if rates fall, they could actually be bad for tech stocks, which is kind of funny to think about. The different iterations of rates we've had.
Well, I guess, yeah. No, but I mean, nobody's actually saying that lower rates would be bad for tech stock. It would just be
on a relative basis.
Yeah, because it would just be so good for small.
But that would be good that the rest of these companies play catch up for a while. And the active managers we've been saying for the past few weeks that have been in the worst period ever, like this would be a good comeback for them. It makes sense. So this is a JP Morgan chart someone sent us. Implied equity allocation by non-bank investors globally. So they just take global equities as a percentage of total holdings. And I think this is kind of like taking the total assets and backing it out because there's so much money in bonds and cash. And it shows that it was, I don't know, the end of the 90s, equity allocations were 50-55%. They got as low as 30% in the GFC. Now they're back up to hitting 50% and hitting the highs that we saw in like 2006, 2007. So equity allocations have really gone nowhere for this whole century. Couldn't you say this is actually bullish for future returns?
How?
That people have just been way too underweight equities for far too long. And I think that they've realized this. And I continue to believe this will drift higher with target date funds and automatic investing. And the counter would be, well, boomers are going to be selling in the years ahead. They're going to be de-risking. I think that you could make the case people have been way underinvested equities. Or maybe the point of this chart is just that there's way more cash and bonds in the world than people realize.
Yeah, I don't know. I feel like this is a pretty noisy chart. I don't see any signal here. But like, you think it's going to break out? I mean, it does look like that, but
I think the trend, like valuation trending higher over the years, I think equity allocations should be doing the same thing.
But don't you think this? I mean, this is more of a function of the performance of stocks versus bonds than people's allocating. But you know what I mean? Like, stocks are a bigger weighting because they've had a tremendous return. Bonds have gone nowhere for the last decade. So I don't think it's investors necessarily making decisions as much as it is market caps.
Yeah, I think this should be higher. And I think there's structural reasons for it to be higher. Again, like the 401k target date stuff. And I think people, that those trends, I think should slowly but surely push equity allocations higher.
I mean, I'm all for it.
It should be higher. That's all I'm getting at.
Tom and Smith posted this chart on Twitter showing the composition of debt held by the public. 2/3 of public debt is held by domestic holders. This is a big topic, obviously. The deficit, how much borrowing costs the United States government. But the good news is that, what did he say? $892 billion in risk-free interest income, largely going into the pockets of the U.S. households, investors and institutions, pensions funds, the Fed, the government itself, state and local governments, and some of our closest foreign allies. So, yes, absolutely, the numbers are eye-watering, but we're paying ourselves.
That's the other weird part here, that the It shows the Fed is getting interest on these and state and local governments. That's the bizarre part to try to wrap your head around. Is that, yeah, it is switching money from your left pocket to your right pocket in some ways.
Yeah. No, again, I'm not minimizing. 1/3 of public debt is held by foreigners. So it's, we are reliant on foreign lenders for sure, but 2/3 going right back to us.
But yeah, every liability is also an asset. That's the whole point here.
Yeah.
So the higher yields, yes, it's a lot for the government to be paying, but it's a lot of it's staying in the system. All right, good one from DataTrek here. I like their charts. They show the trend line for credit cards balances going back to the mid 2010s. Remember back that period, Michael, that golden economic period everyone fawns over still?
They won't stop talking about it.
So they show the annual growth rate in credit card balances from 2014 to 2019 was 5.9%. Then you had this huge 13% drawdown in credit card balances as people paid it off in the pandemic. And now it's right back on trend. From 2020 to 2024, it was a 5% compound annual growth rate. But Nick Colas was saying about this that it's kind of surprising that this thing is just still on trend, especially with inflation, that you didn't get a much higher bump up in credit card debt.
Is this too zoomed out?
I don't know. I think it's interesting though. You would have thought there would have been like a big overswing to the other side of credit card debt going way, way above just from people spending more because we have a 20% higher inflation.
Yeah, but there was look at the change from the bottom to the top.
But it just put us back on trend though. I'm thinking of an overshoot. CAGR. It's not that much.
Yeah, maybe it's not.
That's less than inflation. That's probably about an inflation rate.
But is it from the bottom?
Yeah, 2020 to 2024, we have 5.1%. So I guess you're right. 2020 includes the period where it fell.
But my point is, if you measure from the bottom to today, right? That's a lot. That's a lot.
I'm looking for an overshoot though. It's just the fact that it's back on trend is that's interesting. You would have thought it'd been higher.
Good news on the credit card stuff. We've been talking a couple of months ago, months, I don't know, about delinquencies picking up. Jack Farley tweeted 90+ day credit card delinquencies, looking at data from JP Morgan, Wells Fargo, and Citi, and they're going lower. It's a good thing. I was listening to the JP.
These numbers are also, regardless if there was an uptick, they're really small. They're all less than 1.5%.
Yeah, but directionally, you want to see them obviously going down, not up. I was listening to JP Morgan's call on the Quarter app, and there was a quote about credit card delinquencies. So Jamie Dimon was on the call. This was Jeremy Barnum, I guess his right-hand man, who was often on the calls with him. He said, I still feel like when it comes to charge-offs and delinquencies, there's just not much to see. It's still normalization, not deterioration. It's in line with expectations. It's all good. There's nothing with nothing.
Okay. Ed Yardeni did this one, household debt to service ratio, which we've talked about for a few years now. Still looks pretty darn good. If you take away the pandemic period, it's as low as it's ever been since they started tracking this in 1980. So consumers are still in pretty good shape. All right. So this used to be the Credit Suisse Global Wealth Report. Now they are owned by UBS, which is bizarre. So they just kind of take them over. It would kind of be like someone else who would let's say some company bought Standard & Poor's, right? Bloomberg buys Standard & Poor's, and now it's the Bloomberg 500. That would be weird, wouldn't it?
Well, remember when they bought the Barclays aggregate?
The ag, yeah. It used to be called Lehman. All right, so percentage of people worldwide who are millionaires. This is including household wealth. So this is through 2023.
This is including household wealth? What do you mean?
No, this is including your house.
Okay, got it.
So what percentage of, this is worldwide, not US, are millionaires? What do you think?
4?
1.5%. That's up from 0.5% in 2000. So it's not a big number of people. And they have this chart here that shows they break down the percentage of adults by different levels of wealth. So it's under 10,000, 10 to 100, 100 to a million, and over a million. And the biggest group in 2000 by far was under $10,000. This is worldwide again, not just the US. 75% of people in 2000 had wealth that equated to less than $10,000. That's dropped from 75% to 39%.
Wow.
And now the biggest group is 10 to 20. So they show all these stats in here that show wealth inequality is still crazy. There's like 26 people who control 20% of the wealth in the world. The people with 50 billion in the buck is like 26 of them. They control 20%. And that 1.5% millionaires, they control 50% of global wealth, which is just an insane number. But you also have this progress of people on the bottom are slowly but surely progressing. And obviously part of that is inflation, but that bottom end is coming up too, which is good.
Very good.
So yeah, I don't know. I guess my point is that, I don't know, wealth inequality is always going to be here and always going to be a problem, but people on the bottom are coming up a little bit too. How's that?
Good. Ben, I want to play a clip from Car Dealership Guy.
How much money are you making right now on selling Cybertrucks?
So it really depends what my cost is in them and what the offer that's coming in. I could still make $15,000 or I can make $3,000. I've been pretty much dollar cost averaging in any new Cybertruck coming in, and I'm trying to unload any ones that I'm heavy in for.
Dollar cost averaging to Cybertrucks.
Okay, I think I actually saw this clip.
All right, that wasn't the point of the clip. Let me keep going. I just thought that was funny.
How much are you buying them for?
So right now we're paying $105.
And typically, what's your average sales price?
Right now, at $117 is a pretty easy sales price.
Got it.
At this time, I hope, for the next couple of days.
And what were you selling them for 3 months ago?
3 months ago, I was selling them for $170. So it went from like $200 to $195 to $171, $169 to
Nice.
$160.
Wow.
It's just kept dropping every single week.
And where are we going next?
I think $115 is a good spot to stay and hang out at. It's probably going past that in 3-4 weeks. Who knows?
Got it.
Isn't that wild? Could you imagine having spent $260,000 on a Cybertruck or whatever the number is, $170,000, and now they're going for $115? We spoke last week about
This is like you with your Audi.
I'd be out of my mind. Now, I guess, listen, if you could spend $200,000 on a Cybertruck, money is likely not an issue whatsoever. But nevertheless, it's kind of amazing how much this particular market has fluctuated.
This is one of those cases where the first mover advantage was the opposite of advantage. It was a detractor to you. Right?
Yeah.
Getting in first hurt you.
Know what I saw my first one this week? The car with the toot horn.
What's that?
The car that we spoke about last week. I forget the name of it.
Oh yeah, okay. That has two different horns. Okay.
Kevin said one of his family members got it. I think they're gonna be coming.
I got a horn question for you since we're
go
talking about
ahead.
horns. Okay, red light. There's a intersection here on Cascade Road where there's a red light, and then in 100 yards there's another red light, right? And the person in the right lane of me,
How many lanes?
left turn lane and 2 lanes.
So there's
Right.
a left turn lane and then 2 additional lanes?
Yes.
Okay.
So this person is one car ahead of me, takes off when the light turns green, cuts me off and the other person in the left lane to get in the left lane of the next light. So total cuts across 3 lanes of traffic basically, so they can make the left-hand turn.
Hold on. Details. This is important. When you say cut you off, did you have to press your brake or did they speed ahead and?
Oh, I had to press my brake for sure. I would have hit them.
Ooh, okay.
I honked.
Of
Fair?
course. Absolutely. An
All right.
aggressive honk.
Thank you.
Yeah.
All right, just making sure.
Yeah. No, if somebody cuts you off, you aggressive honk.
Yeah.
You know what somebody showed me yesterday? The Rivian, not the pickup truck, the actual, the SUV.
It's a cool looking car, right?
Looks very nice.
I like them.
Looks very nice.
That's your midlife crisis car right there.
How is that a crisis? How's that a crisis car?
You're ready to spend up on a car. You've been talking about it forever. Just do it. Rip the Band-Aid off.
With the electric credits, they're like not super duper expensive. Somebody said $600 a month.
For a Rivian?
Yeah.
It sounds like a cheap monthly payment to me, based on how much they are.
How much are they?
I'm trying to do the math here. I'm doing Zach Galifianakis. I thought they're pretty expensive, aren't they? 90 or 100?
I don't
Maybe
know.
it's a lease price. Okay. All right.
Last week, funny how much things can change in a week. Last week, we were talking about the weakness in crypto and flows impacting prices or not. So Eric tweeted, Balchunas tweeted, and this is a week ago, actually, during the drawdown. He said Bitcoin had a 20% drawdown in a month flat, pretty nasty. I would have been impressed if 90% of the AUM hung in there, but it was over 100% as they saw inflows. The boomers hung tough, even tougher than I predicted, and kept the, all right, whatever. So flows
So wait,
were not,
what we're calling ETF buyers boomers?
well, that's what Eric's calling them.
Is that the crypto nomenclature? Okay.
But then this morning he tweeted, $300 million in flows yesterday, $1 billion for the week. Year-to-date net total crossed $16 billion for the first time. Their estimate for the first 12 months was $12 to $15 billion. So already cleared that with 6 months to go. And Bitcoin has had a pretty substantial run.
How about this? We've talked over the years about how stock market investors have become more attuned to like staying the course and understanding that there's going to be corrections and bear markets and even crashes along the way. And there aren't as many people who completely give up. Because of the volatility in crypto, it seems like investors in crypto have learned this better. So you have a 20% decline over a couple of weeks. Whoa, that seems crazy, but people are used to that kind of volatility in crypto.
Yeah.
They've learned.
And Bianco's done a lot of work on this. Like the average ticket, the average trade is not a giant number. I don't know what the number is, but if it's $7,000, like, all right, you lose 20%, probably not going to panic. Duncan shared this with us. The R1S, that's what the Rivian is called, is now leasing available configurations for $699 a month. Nice. Pretty good deal.
I feel like you never get the deals on the commercials though. The commercials say, like, come in now and get this truck for $299 a month lease.
It's like $6,000 down.
Yeah, it's like, oh, if you have a family member who works here, and I feel like those numbers, but that doesn't sound bad for a Rivian. All right, from Zillow, in 2022, there was 134 families residing in the U.S. who did not live in the home, or did not own the home that they lived in.
How many?
134 million. Sound high to you? Low? I mean, that makes sense for the housing ownership numbers, right?
Wait. In 2022, 39% of the roughly 134 million families residing in the U.S. did not own the home they lived in.
Oh, yeah, sorry. So I read that wrong. Okay. So 134 million families, 39% of them didn't. So
does that mean 39% rent? Is that what they're saying?
Yes.
Okay.
So they're talking about some families choose to rent, but others simply could not afford. Among those who did not own their home, 7.9 million were mortgage ready, meaning their share of their income spent on a mortgage payment for the typical home in their local market would have been 30% or lower, which obviously a lot of people go higher than that, but that's a very small number to me, it seems like. Out of the people who were like, could afford a mortgage.
The question now that keeps coming up is what is going to happen with activity? Well, we know what happens with activity. What's going to happen with prices when mortgage rates come down? And there's the thinking that like, well, just lower rates mean higher prices, right? Like that's just what we've been taught to believe. You could make the argument that lower rates is going to do more on the supply side than the demand side, because lower rates are going to allow people to move, and so it would unlock supply. Which
would be the opposite of history. Usually, if rates go higher, supply goes up. Rates go lower, supply goes down.
And I've been saying that, like in my head, I've been thinking that demand hasn't really changed a lot. People were looking for houses; they're still looking for houses, unless rates got so high, prices got so high, which they did, that it just priced people out of the market. And if rates come down, then all of those people are going to come flooding back into the market, in which case demand would outstrip supply again and prices would go higher.
Here's the other thing. It's kind of like this. People always say there's no such thing as cash on the sidelines for the stock market, because for every buyer, there has to be a seller. For the people who've been waiting to sell their home, they would also be a buyer, right? So the supply and demand there's young people who don't have a house who'd be coming in off the sidelines, but also the people who are selling their existing home and looking to buy another one.
All right, now my head hurts.
Right? No such thing as cash on the sideline. All right, cool one from Luke Cowa at Sherwood News. He posts the thing from Bank of America about how much it costs to build a house in 2024. And they go through all the different features here and how much they cost. But this was interesting to me. So this is from Bank of America. We estimate the bill of materials to build a house has increased at a compound annual growth rate. I can't make myself say CAGR.
Why?
I feel like that you can only say that if you're a quant.
No.
I can't. That's like a West Grade. Like I can't say CAGR. It's just.
Well, listen, don't let your insecurities impact me. I'm a CAGR guy.
You know what else I can't say? I would never be able to pull this off. Fam. What's up, fam? You know, people do that.
Yeah, no offense to people that say fam, but it's a bit of a because it's like if you're a 40-year-old white guy, I'm sorry, just stop.
I mean, you think in your head it sounds cool. It doesn't sound cool to everyone else. All right. So the CAGR compound was 3.8% since 1982, which has outpaced inflation, but not much. That seems relatively low to me. That because housing prices have grown at way more than that, right? So 3.8% since 1982 to build a house. So they're saying outside of materials, raw land as well as development entitlement costs are rising at a lot faster than direct building costs. So the point is, it's the land that's going up in price so much, not so much the amount it costs to build a home. Does that make sense?
Yeah.
It's the land because they're not making more of it, right? Is that what they say? All right. Mike Simonson, one of our favorite people for real estate stats. This is interesting. American mortgage holders carry only 48% loan to value on their home, down from 70% a decade ago. It's really hard to overstate how strong a financial position American homeowners are in. I mean, look at this thing go down. It is pretty crazy. This is the home equity boom that I've been talking about and waiting for. Because you need to have like a 20% loan to value ratio, right? You need to have at least 20% in your home in equity to start borrowing against it. There's a lot of people who have the ability to borrow if they want.
It's coming.
I would think so. I'd be shocked if it didn't happen. With lower rates. With lower rates coming and all this equity just sitting there, I just can't see people being like, nah, not going to do anything with it. It's just it's not the American way to let that money just sit there.
Who did you open the show taking a flamethrower to
I don't know.
today?
I didn't take a flamethrower to anyone, did I?
I feel like you did.
No flamethrowers for me. Oh, jet ski owners?
Oh, jet ski owners. Yeah. last week I forgot to mention that, of course, Ben hates fireworks.
No, I don't hate fireworks. My firework opinion has evolved over the years. I hated fireworks when my kids were young, and it would scare our dog, and it would like wake our kids up in the middle of the night. Now our kids are older; they see them. But my only new take for fireworks is, if you've seen one fireworks show, you've seen them all. I'm ready for the drone light shows to come. Like fireworks shows are all kind of the same.
It's true, but aren't they great every time? I mean, how often do you see a fireworks show? Once a year?
Yeah, once a year.
Yeah.
It should be like the Olympics, once every 4 years. Absence makes the heart grow fonder.
Somebody emailed us. I feel like Ben wouldn't like me. I drive a truck, love small talk, especially how fast time goes, and I don't drink. But I still feel like we'd get along when it comes to investing. Love me some target date funds.
I don't hate truck drivers. I just hate the fact that they take up my parking spaces. Although here's all right. So if we're gonna do a flamethrower, you open up Pandora's box here. Here's my problem with truck drivers. On the highway, they never use their cruise control. This has to be true of truck drivers more than anyone.
Wait, what?
Truck drivers never use their cruise control on the highway because if you try to pass them, they speed up. Truck drivers do not like to get
That's
passed.
true. They have the personality of you will not pass.
Yes. I'm just saying they've got to be cruise control on with all the bells and whistles they have now. Just turn it on. Let it go. I don't care if someone passes me.
You know who I hate truly on the road? People with loud motorcycles.
They're getting louder, it seems like.
And then furthermore, there was a guy, we were on our way to the beach this weekend in 2 lanes, and a guy with the crazy, obnoxious, loud motorcycle, the type that passes you jump, right?
Oh, yeah.
Passed tightly in between the 2 cars, woke Logan up. Those people. I don't hate the motorcycles. I don't just hate the motorcycles. I hate the drivers too.
When
unlike
the motorcycle,
Ben, who won't take a stand against truck drivers. I hate motorcycle drivers.
Yeah, when they pass through go in between 2 cars when there's no lane, that's crazy that you would even try that.
All right, sorry, where were we?
Private markets.
Okay. Allison Traeger wrote a post at Bloomberg. In 2023, the value of North American private equity assets under management was estimated to be $3.5 trillion, more than 10 times what it was 2 decades earlier. And there's a chart showing the North America-focused private equity assets under management. The title of the chart is "Does this look like a bubble?" And I don't know that the growth of an asset class alone is enough to call it a bubble. For example, investment-grade bond funds. Now, actually, I guess some people would say, yeah, that is a bubble. In fact, was it Bill Gross who was calling bonds a bubble?
Probably, yes.
Do you remember that?
When rates were at 4% or something, yes.
And yeah, I remember having this conversation. How could bonds be in a bubble? At worst case, investors get their money back with a low return. Not at worst case, but sure, absent a wave of defaults. But
I started writing about worries about private equity in like 2015. So I'm willing to say I would never call this stuff a bubble because I've been wrong about it. I was wrong about it for so long that I think the point is it just takes so long for this stuff to play out that it won't happen right away. It's a slow bleed.
So to that point, Ben, about you starting to write about this cautiously in 2015, I feel like this is like the new hot thing for the media is like asking questions. Not that the questions are unfair, but there was an article in the journal, pensions piled into private equity. Now they can't get out. And there just wasn't a lot. There wasn't a lot in here. There wasn't a lot of new information in here.
That's a feature of private markets. It's hard to get out.
There wasn't really anything salacious in here. They talked about
it's planting the seeds for in case there's a future problem. There's not going to be a blow up here. It's going to be a slow death.
So here's a quote. Pension funds are selling private equity fund stakes secondhand, often taking a financial hit in the process. Secondary market buyers last year paid an average of 85% of the value of the assets that were signed 3 to 6 months before the sale. Secondhand sales by private equity investors increased 7% to $60 billion last year. So it's not like there's nothing to talk about. Like there's things to report on, but I feel like they're like just sort of really wanting the smoke to turn into fire here.
My whole thing here is that the results that these pension funds and these endowments and foundations, the most of them, some of them are in good funds. Most of them are in crappy funds, and they don't even realize how bad the returns are because it's a compounded annual return that you get in the stock market when you put $10,000 in one day and you get it out 10 years later is way different than the IRR they report to you for a private equity fund where the money gets invested slowly but surely over time. I think that the results are just way worse than these pension funds even realize, and they don't even know what their dollar for dollar returns are in a lot of ways.
Yeah. So yeah, it matters a lot because the holders, these pension fund, the people that make up the pension funds are often teachers, policemen, firefighters. Like it matters a great deal, but there's just not like a ton of news right now.
Yeah, it's not a headline event.
Right.
All right, survey of the week. This is the Labor, Income, Finances, and Expectations Survey. That's LIFE, if you get that, from the Federal Reserve Bank of Philadelphia. I feel like we don't hear much from the Philadelphia Bank of Federal Reserve, right? St. Louis is in a lot. Minneapolis gets some hits a little bit. Not a lot from Philly
You don't
Fed.
hear about the Philly Fed. That's right.
I guess the expectations one. Okay, so they asked people the percentage of respondents reporting trouble paying bills, and they did this by age and by income, male, female. The number of people over time is always around 1/5. This goes back to April 2023, so it's like the last year. It's roughly 20-some% of people having trouble paying their bills. And then it shows it by income, so less than 40 grand a year is like 1/3 of people have trouble paying their bills. People who make 150 grand or over, it's now what's the percentage? Not 7%.
6.9.
6.9%.
Nice.
Well, these seem like the kind of survey results to me that I can't like verify them at all, but they seem directionally right to me. And is this one of those things where it's literally always the case? When we did our show a couple weeks ago, we called it Living Paycheck to Paycheck based on some satirical Twitter post that I wrote. And someone wrote in, hey, I thought you guys were really going to talk about living paycheck to paycheck. And my whole thinking is that, unfortunately, for a segment of the population, this is always going to be a problem.
Yeah.
I don't know that this probably changes a little bit, but if you can see from the survey, this is just over the past year, it probably doesn't change all that much.
Yeah.
Unfortunately.
But I think that these surveys are right because somebody knows how much they're paying, how much they make.
Yes.
You're not asking them how they're going to feel in a year from now. And they know if they're having trouble paying their bills for the most part.
Yeah.
This is a cool chart from Rick Reeder. Click-to-door speed for U.S. digital purchases. Showing Amazon and other. And Amazon is just killing it. It used to take 4 days. Now it's 1.5 days. You know what I just ordered? This is going to look... Robin is not happy about this. I played basketball on Saturday outside, and it was steaming, piping hot. And I forgot to put on sunscreen, which, given my head situation, is dangerous.
I'm surprised you're not a do-rag guy when you play your men's league.
Let me get there. So I wore So yeah, I was naked out there, and my head got burned, not terribly, but it, not good. And if I put on sunscreen, which I usually do, like it drips into the eyes, and then my day is ruined because it stings like forever. So I bought.
You got to get the no tear sunscreen like my kids have.
It doesn't work on a bald head. Come on,
Probably.
a bald head. You could fry an egg on my head. The sun is directly on. So I bought a Nike. I bought two things. I bought one Nike skull cap, like what Debo wears.
Okay.
Sort of excited to see how that one looks. And I bought like a big thick headband that has like it doesn't cover the entire skull. There's like a yarmulke sized hole, so I could do that, look a little bit less ridiculous, and just put sunscreen on the top of that. I think that's probably what I'm going to end up doing.
I think you need to get the tie-dye hat backwards like Woody Harrelson and
Dude,
When They Can't Jump.
So many people suggested that, but I can't play basketball with a hat.
Okay.
And plus, I'm not trying to be a complete clown.
All right. Well, the Nike skull cap. I need to see a picture of that. All right. So what you need to do before you play basketball is stretch out your shins and your calves better, because we got so many comments from people saying when you said your foot hurts when you get out of bed, Michael has plantar fasciitis, which you keep fighting middle age. Middle age.
I don't think
ailment.
I have plantar fasciitis. It doesn't hurt that much.
If it's just sore like that, just stretch out your calves and your shins a little bit more.
It just hurts.
Go against the wall where you push your foot up against it, and then
it hurts for 3 steps. That's about it. We got a lot of emails about people that are fans of the manual car wash. Of course, our very own Bill Sweet washes his cars.
That doesn't surprise me.
No,
I could see Bill being a manual car wash guy. Someone said, yeah, I do it in the morning, and it's my like meditation. Happy place. Good. Okay.
I get it.
Yeah, makes sense.
So we got another email we spoke about the Concorde last week, and it's just physics. Like why'd it go away? And this person said that the cost of flying faster increases like non-linearly. So if you go from 400 miles an hour to 800, it's not twice the gas price. It's a lot more than that. So,
but Duncan did send us this Boom factory that is trying to make supersonic airliners. What is it? Isn't it in North Carolina or something? So this could be coming back.
I hope so.
Supersonic revival.
We're looking to move fast. All right, Ben, recommendations. What do you got?
I don't got much this week.
Good. I
rewatched The Girl with the Dragon Tattoo on HBO.
Which one?
The first one. The Girl with the Dragon Tattoo.
The English one or the non-English one?
Oh, I mean the David Fincher one.
Okay. Really good.
So I mean I got really into those books. I read the book.
Same.
Remember the whole story, the Stieg Larsson guy. He wrote the books, then he passed away, and so it was this big. And the books were like a phenomenon. I remember it was like a beach reading thing.
So good.
And the books were really good. And the first movie came out, and it was an amazing cast. And David Fincher directed the movies, and I thought they did a wonderful job with them. And then they just didn't make a sequel.
Yeah, no, I'd sign up for a sequel.
And I had to go read it. And I guess the reason is they spent $90 million and only made $100, and the studio yanked it, which is crazy to me that David Fincher would have wanted to make a trilogy based on these. And the second one, the second book I thought was just as good as the first. That would have been a really good movie.
What was that called? The Hornet's Nest? The Girl Who Cooked the Hornet's Nest?
I can't remember. That sounds right.
Okay. Yeah, very good movie. Are you watching The Boys?
I gave up after the first season. No reason. I liked it, but I just for some reason never got back into it. But I did like it.
I stopped watching last season. It's just the shock value of season 1 was phenomenal, and I like season 2 as well. But just sort of wore off. It's not like the story's that great.
It's one of those stories. Yeah, where I can see that.
Okay, so I was in the city on Thursday night with my friends, and I stayed in the city to see Longlegs, which is a movie that I have been greatly looking forward to. Longlegs is with stars Nicolas Cage as a serial killer.
I feel like Nicolas Cage has a new movie out every 3 months.
Check out this. Nick Cage did a interview with the Wall Street Journal, and they asked him, what time do you get up on Mondays, and what's the first thing you do after waking up? It could be anywhere from 2 a.m. to 5 a.m. It oscillates quite a bit. That's a wide range. And he said, the first thing I do is see my daughter. After I know she's comfortable and back to sleep, I get on the elliptical and do about 5 miles, then maybe some weights. With that early wake up, what time are you going to bed? We start winding down around 7:30, so I'm usually knocked out at 8.
Okay. Nick Cage, early morning routine. He should be CEO.
So anyhow, all right. So Longlegs, why was I looking forward to it so much? I don't know what the people at Neon did to get this hype machine going, but it was hyped. Scariest movie I've seen in years. Just the trailer looked great. So I stayed in the city to see it because I could have seen it on Friday at 12 in the afternoon. I would have been the only person in the theater. So I stayed in the city and it was sold out. Sold out. I don't know if I've ever been to a movie that was sold out. I sat in the second row corner, obviously by myself. And the movie was just incredibly underwhelming relative to the anticipation. Now, the movie itself was fine. Like it was good. It was dark and dreary and dreadful, and it was like any decent Shudder movie.
But earnings missed estimates.
Yeah, it was like a 6.6. It was a good Shudder movie. I just don't. So I'm not mad. I liked it. It wasn't scary at all though, and I just don't quite understand how they were able to catch lightning in a bottle at the box office. It did like 22 or $23 million. So
you mentioned it last week, and I'd honestly never heard of it before.
Okay.
You said like you were really excited to see it. You couldn't wait, and I'd never heard of it.
Yeah. Well, a little disappointed. Horizon 2 pulled. It was supposed to come out in August. Not happening anymore.
This was the easiest entertainment prediction to make all summer that this thing was going to bomb.
Yeah. So it did. It just came to VOD today. And I might watch it in 3 sittings.
Isn't it crazy how quickly these movies come to video on demand now?
Yeah. It's pretty exciting.
It's like, it's just a couple weeks a lot of times.
It's pretty exciting. All right, Ben, I've got something for you. I was watching Beverly Hills Cop last week, as we mentioned. And I had a thought. Bill Simmons' voice. Are we sure Kevin Bacon's a good actor? Hasn't he just played with a lot of really good actors? Like, are we sure he's good?
Really?
So
make your case, because I'm ready to refute this.
All right, so I did some work on this. I didn't put it in the docs. I wanted you to go in fresh and be surprised. I had Sean and Chart Kid pull some numbers. So now I'm going to drop some of these things into the doc.
All right, you do that while I go on IMDb, because
Ben, you don't need to do all that. I've got it.
Okay, all right.
I've got it all. Sit back and relax and let me cook.
At least once a year, you do a movie like deep dive on a spreadsheet.
So I saw this data and I felt like this is like my finest hour. I've never felt more right about anything ever. Now, in fairness to Kevin Bacon,
he's a character actor.
He's a character actor, and oftentimes the characters that he plays are shitheads, right? Like he plays bad guys. The River Wild, Magneto, Beverly Hills Cop. For the most part, he doesn't Sleepers. He doesn't play people that you root for, right? So okay. So I had Sean pull the data, and what we looked at was the average box office and the total box office. We inflation adjusted it, the average Rotten Tomato scores, and the average audience score for the movies. And I have Tom Hanks, Ed Norton, Matt Damon, Denzel, DiCaprio, Tom Cruise, Brad Pitt, Joaquin Phoenix, Kevin Costner, Ben Affleck, Matthew McConaughey, Alec Baldwin, Sam Jackson, Will Smith, and Kevin Bacon. All right, Ben. Check the doc.
Okay.
First
Where am I
chart.
looking?
First chart. So I was right. Kevin Bacon has the lowest average Rotten Tomato scores from the critics and the audience and the average.
I think this isn't fair, though. He's not in the same league as these guys.
Agreed. Well, exactly. Chart 2. Look at this eye candy. So we have a scatter plot. Total box office, inflation adjusted, and the Rotten Tomato score. Look at this chart. Kevin Bacon,
Okay.
Bottom left, not where you want to be.
I love Sam Jackson. Just about as bad at movies, but he made way more money.
Okay,
it's all the Marvel movies.
All right, and then last one. This is really the coup de grace. This is gorgeous. So we're looking at all of the movies from all of these actors.
See, look where Tom Cruise is. He's in the perfect spot. Tom Cruise is the efficient frontier of movie, right?
Yeah.
He makes money and they're good movies. Tom
Yeah.
Cruise is the efficient frontier of actors.
All right, Ben, look at this. Can you see this, or is it too small?
Kevin Bacon movies, total box office inflation adjusted average. Okay.
So there's a lot. Look at all those movies below 40 that just bombed. But there's a lot of them.
Okay, he did a lot. You know why he did so many movies though? Because he invested in Bernie Madoff. He needed to make all these crappy movies to make his money back.
I understand. After the GFC, he made a whole lot of bad movies, and he did go on a great run. So his 90s was really phenomenal.
Tremors.
So it started with Tremors. There's a lot of
still
dozen
holds
here,
up to
but
this day.
JFK, A Few Good Men, The River Wild, Murder in the First, Apollo 13, Sleepers,
Mystic River in the
Wild
2000s.
Things. That's a good run.
Yes. Okay.
I'm just not sure if Kevin Bacon's
That's
a good
fair.
actor.
From a quality basis, you're right. There's more quantity than quality, but the stuff that he did good, it's all character stuff that he did. You know what's a good movie of his? Stir of Echoes. You ever see that one?
I don't know if I did.
Not a bad one.
Was that a horror movie?
No, it's more like a thriller.
Okay.
Murder in the First was a very good one for him
Murder
too.
in the First was good.
But yeah, so to your point, he could not carry a movie, which is why he had to do so many.
Yeah.
That's fair. This is good charts.
Thank you.
I'll give you credit here.
Well, I feel like the numbers supported my thesis. It's my finest hour.
I do like Kevin Bacon though.
Who doesn't like Kevin Bacon? But that's the point. Everyone loves Kevin Bacon. Maybe a little bit too much.
Okay, how much of his star has been risen up by the 6 degrees of Kevin Bacon?
A lot.
Okay.
All right, Ben. That's it for us.
Thanks to the production team as always. Duncan, John, Daniel, we appreciate it. Thanks to YCharts for sponsoring. And is that it? We'll see you next time. Oh, next week, we're talking Future Proof.
Yes.
I got excited again. We interview Matt Middleton for Talk Your Book next week, and we talk about Future Proof and what's coming this year, what's different, what's the same, and I got all ready to go again. It's 2 months away. You know what I was listening to yesterday? I went for a jog yesterday and was listening to music. Third Eye Blind the whole way. I'm ready.
Let's go.
See you next time.